Right. All right, Manishi Raychaudhuri joins us. Let's take our conversation forward and let's see if he is in sync with what markets are doing right now, both in terms of action and in terms of reorientation. Manishi, good morning. Thank you for joining us. What a week it's been, Manishi. What a week it's been.
Absolutely. Yes. So, it kind of reaffirms the stance on India that we have had. We have had an overweight stance on India in our Asian model portfolio for quite some time. The budget has not only reaffirmed that, but also it has possibly surprised on the upside, because while one would have expected some degree of growth focus, the kind of capital expenditure focus and a move away from the concerns about fiscal deficit that we have historically seen in Indian budgets, that was clearly unanticipated. And we think that this focus on capital expenditure, the focus on divestments, would not only increase or kickstart excitement, it would also possibly bolster the sentiments for many of the under-owned sectors. If one looks at industrials or materials or financials, these sectors have been under-owned in India for quite a few years now. And I think that's where the importance of this budget for the equity market comes in. It has also, I would mention, been a very honest statement. For the first time, the central government is actually acknowledging that the fiscal deficit numbers are actually higher than what they have been saying for past few years. There are payables to the Food Corporation of India which have been brought into the budget. And therefore, I think it's a combination of these honest accounting and the focus on growth that has really taken the market, led the market to embrace it with both arms.
For those who have not participated, for those who are worried about valuations, for those who not believe that India is on its way to greater glory, both in economic terms and also in stock market levels, what are you telling them? Should they buy now? Should they wait for a sizable correction?
Valuations, have been a concern for a while, particularly among the foreign investors who look at the entire spectrum of Asian markets, and that's because India has been at a premium valuation for quite some time. But we are pointing out to them that the earnings estimate increases, the earnings estimate upward revision in India, are actually much stronger than many of the counterparts, even the counterparts like Korea and Taiwan, which have benefited from this huge demand for tech hardware and semiconductors. So we think that it's not too late to buy into India. We think that there are still sectors in India which are under-owned, and as I earlier said, that financials, materials and industrials and other domestic cyclicals like consumer discretionary, they're possibly under-owned by the institutional investor base. So, we don't think it's too late to buy into the India story.
What are you making of the kind of numbers and the runaway move we're seeing on an SBI post earnings, Manishi? Even if you won't comment specifically on the one stock, the fact that this is a PSU major that's perhaps been not been necessarily given its due by the market so far.
I would tend to agree with that. The PSU bank universe is a bit of a mixed bag. There are the market leaders and, I would say segment leaders who are leaders in certain regions of India who tend to do well in times like these. In India, as I've been saying for a while, we are seeing this phenomenon of the big getting bigger, the market leaders gaining market share. And we're also seeing that some of these large lenders, the concerns about their asset quality is actually being pushed back in the sense that we have possibly seen the worst behind us now. And their large balance sheets and lending profiles make their overall asset quality relatively less risky than their smaller counterparts. And I think, in the PSU banking space, one has to be a bit careful. One has to be selective. One has to choose these, the market leader kind of exposures who would tend to benefit going forward. It's not a broad brush exposure to PSU banks that we are recommending. Our preference in general still lies for the private sector banks. But yes, there are select opportunities in that space now.
Manishi, I can't help but ask, given the fact that we just continue to ride higher, the naysayers will say we're bound to see a correction, and valuations are sort of really asking for that. I know in the longer term, the story is intact, as we've been hearing all across in terms of growth and the opportunity for India. But the steam of and the pace at which we've seen this move post the budget, is that something that, that causes any apprehension, or do you really see the strength and conviction sustaining in this rally?
You see, short-term corrections are unpredictable. And if we do have a correction, and those are part and parcel of the investing game in risky assets, and institutional investors who are mature investors do understand that. We believe that for a market like India, which is underpinned on fundamentals right now, a correction would possibly provide a buying opportunity. We have seen foreign institutional investors, not exactly over the past 3 to 6 months, but earlier, reducing their positions on India. So that historical argument that we had that India was over-owned by foreign institutions, that's no longer valid. I think emerging market investors are possibly just about neutralish on India. Asia ex-Japan is slightly underweight, maybe just about 1% higher than the benchmark. And that enthusiasm about Indian growth revival, and more importantly about Indian earnings revival, that's just beginning to catch on. So we think that if there is a correction like we had seen a couple of weeks ago, that would possibly be treated as a buying opportunity by most investors. And coming to the point about the post-budget rally that you made, we must also remember that pre-budget, there was a correction of about 5 to 6%. So the post-budget rally has only taken the market back to the earlier trajectory. The post-budget scenario has also added a degree of bullishness about growth focus, and more importantly, about the capex cycle restarting. And as we all know, that the capex multiplier or the manufacturing multiplier is a lot stronger than the consumption multiplier that India had historically been relying on.
Okay, that's how the texture of the market is panning out. 15,000 here for the Nifty. It's a solid market breadth as well that you're seeing in SBI leading the gains all the way. Manishi, how comfortable are you owning PSUs?
As I said earlier, that, if you sort of compartmentalize our public sector companies, a large chunk of that would be in the banks. The second important basket would be in the oil companies, both oil explorers and the oil marketing companies. In the banks, one has to be a bit selective. The market leaders, and particularly those companies, those banks which are able to put the asset quality question behind them, they are our favorites right now. Among the oil and gas or the energy space, we're a little more positive on the refining and marketing companies than the explorers. I think even the numbers in the budget tells us that the government is likely to rely on market-driven mechanism as far as price setting is concerned. So, the oil refining and marketing companies should actually continue to do well in such a scenario. So I think in both spaces there's a scope for being selective, being stock specific. But in general, I would think that the environment for PSU investment has possibly improved in a post-budget scenario.